big gap down, and it is opening below that May 20th low. That was the most recent attempt at a bottom. The bears see this as a higher high double top, and they want a break below the May 20th low, which we're doing right now, and then a 400-point measure move down. This is 400 points. That would get us down to 3,400, which is close to the pre-pandemic high. And on the weekly chart, you can't see it as a double top, but you can argue it's an attempt at a double bottom. And if we break below this May 20th low, then you'd look for a measure to move down based upon that height, which is 400 points, and that gets us down here. I got to write May 20th here. I talked several months ago about this as being a double top, and this is the neckline, and we broke below the neckline, and this is a breakout test of that neckline. A measure move down from that double top is down here around 3,600. This is the pre-pandemic high around 3,300, and I think that's the debate. Are we going to get down to the pre-pandemic high? I still do not think we'll get there, at least not this first time down, but we might. Bulls hope that we get a double bottom and we reverse up, break above the neckline, and go up here. And the bears hope that we fall for the measure move down. On the monthly chart, by the way, I think today's probably going to be sideways to up. I'll explain why in a minute. Monthly chart, really strong bull trend. First pullback to the moving average in more than 20 bars. There should be a lot of buyers around the moving average and below. It makes it unlikely that we're going to begin a bear trend on the monthly chart. We're already in a bear trend on the daily chart. We have a series of lower highs and lows. But on the monthly chart, this is still probably a deep pullback in what will become a trading range. That means we'll probably get back up here, possibly later this year, possibly early next year. As strongly down as this is on the daily chart, it's still probably a minor reversal on the monthly chart. The bears want to break back below the pre-pandemic high. They want to get down to the pandemic low. Many stocks have gone down to the pandemic low. Many more have reached the pre-pandemic high, but the overall market has not. As I said, I don't think we'll get there this time down, but we might. I've been saying minimum downside target was 3,900 to 3,700, and that we might get down here. I still think there's a 30% chance we'll get down here, 3,300, before we test back up. And the reason why I think we're going to be sideways to up today is when we're up here ahead of the CPI, we were up. So the market might have to come down on the CPI to maintain some kind of neutrality. And now we're down going into the FOMC, and the market it may be overshooting on the downside, and the fair price might be in the middle of this developing range. And with the FOMC 2 days away, I think we're probably going to try to reverse up instead of continuing down. So instead of getting a third big bear day, I think it will either be a neutral day or a bull day. Bulls hoping that this is the low of the day, and they want as big a bull bar as they can get, and they want the bar to close on near its high for a possible low. The more it's a big bar, the more it closes on its high, the more bulls will buy on the stop above the high of the bar. A lot of bulls will want confirmation, so they'll wait for a second consecutive bull bar. However, we're very far down below the average price, and if you're a bear, of course you want to sell, especially when the market's below the average price, but you do not want to sell things that look bullish. If you're going to be selling far below average, you want things to look far above average bearishness. And this is a big bull bar. That's not bearish. So most bears are not going to sell below one or the close of one. For the bulls, possible low of the day, but a big tail. Bar is very big. So if you do buy above 1 or above 2, you have to trade small. And by small, I mean about 20% of your normal size. So if you normally trade 1 E-mini, you trade 2 micro E-minis. If it continues up, you can buy 2 more, 2 more, 2 more. And if it instead goes down, you don't lose too much. This is kind of similar to what took place on Friday. We had a big gap down and 2 bull bars, the bull bar closing near its high. If you bought a full-size position, you lost money, right? I mean, any size position, you lost money. But the loss would be smaller if you traded a small position size. So you'd buy above that second bull bar, and you'd get out below that bear bar closing near its low, micro double top, low 2, whatever you want to call it. But a lot of bears would sell below that bear bar. Now, bears, they do not want 2 to go above 1 because they know a lot of traders who sold overnight will exit, and they know bulls will start to get confident and buy. This low on the open did not go below the below X low. The bears want to break above this high. That's the highest price between these 2 lows. So we have a double bottom neckline, and the bulls want to measure move up, and the bears want a lower high and a break below the double bottom, and possibly a 20-point measured move down. My general rule on the open is if we get consecutive bull bars, 1 big and closing near its high, it's a buy the closed bar, whether or not there's a gap down or a gap up. And for the bears, 1 is a big problem. It'll reduce the number of bears willing to sell below 3, 4, or 5. The bears will want 2 or 3 bear bars to erase the bullishness of 1 before the bears are willing to sell this far below the average price. When you have a big gap down, 80% of the time you have some kind of a trading range open until the market gets closer to the average price. The moving average, it's a 20-bar exponential moving average, and that means it's based upon 20 bars. And after we've had about 15 bars here, then 15 of the 20 bars from the average are down here. And the average will be down here below the high of the day. But it'll take about 15 sideways to up bars for the market to get close to the average. If the market goes sideways, the average will come down to the market. If the market goes up, the market will go up and the average will come down, and they'll meet somewhere in here. For the bears, a low 1 below bar 2, but with bar 1 being a big bull bar, nobody's going to sell below 2. At least nobody should sell below 2. Yeah, we got the Globex low below. And yes, this is a pullback from the breakout below the May 20th low. So it's a low 1 sell, but far below the average price. You want bars that are far above average bearishness, and the bears will need several bars to undo bar 1. So I would not sell below 2. I would not sell below 1. What happens if we get a pair of bear bars with 1 being big and closing near its low? I'm still not willing to sell this far below the average price when there's such a big bull body. So right now, I would, over the next 2 or 3 bars, I would only look to buy, but I would need a really strong buy bar. I'd need at least a second consecutive bull bar closing near its high, preferably closing above 1. 80% of the time, when you have a big gap down, you're going to have a trading range open. Some kind of a trading range open. Sideways, it could be 10 bars, could be 20 bars, could be 5 bars, but it'll have at least a couple of reversals. Here we reversed up, we reversed down. That makes the trading range open. When the market gets near the moving average, the bears will look for a double top or a wedge top, 1, 2, 3, and then they'll sell. Here's a better wedge top, 1, 2, 3, and they'll sell. And the bulls hope that any sell-off will lead to a double bottom or a wedge bottom, and they'll buy. So the most common thing, 80% of the time on the open, when you have a big gap down, you're going to get some kind of a trading range and either a double top or a double bottom or a wedge top or a wedge bottom. The bears want to sell around the moving average, a double top or a wedge top, and the bulls want to buy a reversal up from a double bottom or a wedge bottom. 20% of the time, you get a trend from the open. In this case, a bull trend from the open, or a bear trend from the open. Sometimes it'll go sideways for 5 or 10 bars and then trend down, but it's basically a trend from the open. And when you get a trend from the open, 20% of the time, it lasts all day. 20% of the time, you get a reversal, and 60% of the time, you get a lot of trading range trading. And that's true whether it's a bear trend on the open or a bull trend on the open. 20% of the time, it's a bull trend day. All day just keeps going up. 20% of the time, it goes up strongly, reverses down. And 60% of the time, you end up with a lot of trading range trading. For the bears, that's a low one sell signal, but one is a problem. We have a big bull bar far below the average price. So, even though it's a big gap down, and this could be a huge bear trend day, I'm not selling below 2. Why not? Well, if it's going to be a huge bear trend day, there'll be plenty of other opportunities to sell, and they will have a higher probability. Right now, this is not a high probability sell because of what 1 looks like. If the bulls get a second reversal up 3, especially a pretty good bull bar closing near its high, that would be a credible buy. We broke below the Globex low and below the low of the open. Bears hope that we keep going down. They're hoping this is sideways, bear flag, another leg down. Sideways, leg down. Sideways, leg down. Sideways, the bears want a leg down. And the bulls are hoping this is a fair price and that now we're below the fair price and we'll reverse up back into the fair price. Or they're hoping this is too far down. In other words, it's cheap and that will rally up to the Globex high. So I'm not yet bearish on what the day will do. But if we get 2 big bear bars closing near their lows, 3 or 4 big bear bars, it becomes sell to close, even though we're far below the average price with a big bull bar for bar 1. Bull's trying to create a high 2, a second reversal up from below yesterday's low. But to buy above 3, most bulls will want to see a bull body, and preferably a relatively big bull body. Any bull body will be enough for the bears from 2 to buy back shorts. To get long and take a chance, it's the low of the day. The bigger 3 is, the more it closes on its high, the more bulls will buy. If it's not a big bull body, a lot of bulls will wait to see if 4 is also a bull bar and then buy. Sideways with 3 bars, we went gap down, we reversed up, we sold up, we're reversing up. Trading range behavior. Remember, my minimum requirement for a trading range open is a pair of reversals after the first bar. We reversed down below 2, we're reversing up above 3. So at the moment, I would call it a trading range open if 4 goes above 3. 4, it's a high 2, possible low of the day, but the bulls did not do a very good job, so most bulls are not going to buy above 3. They'll wait to see what 4 looks like. Can you buy above 3? Absolutely. It's a reasonable candidate for the low of the day, but you have to wonder why the bulls were not able to do something better than just a doji, especially after a big bear bar. The bars do not look big, but they're pretty big. And, so for the high, we have, 25. We have at least a 25-point range already. you can see it's a limit order market. Something bullish, 1, 3, they sold it. Something bearish, 2, they bought it. Traders are betting on reversals and quick moves. Do I still think the odds are today's not going to be a big bear day? I do, and it's for the reasons that I said. We have the FOMC meeting on Wednesday, and we've sold off a lot over the past 3 days, and we've been basically sideways now for 5 or 6 weeks, and we're at the bottom of that range. So whenever the market's in a range, you always look for reversals up near the bottom and reversals down near the top or near the bottom. Reversals are more common than breakouts. And just on that alone, you have to conclude that we're probably not going to successfully break strongly below that May 20th low today. If we get 2 or 3 consecutive bear bars, what am I going to do? I'm going to sell. Because even though the odds are against a big bear day, if we're getting a big bear day, I'm not going to look at it and say, oh, that shouldn't be happening. I'm going to be saying, oh, look, it's a big bear day. I got to sell. So no matter what you think should happen or should not happen, you have to trade what is happening. Remember, in general, you can never be more than 60% certain, which means you can never be more than 40% uncertain. You should assume that the probability, for 95% of the bars on any chart, the probability of the market going up, X number of points, down X number of points is about the same. The probability is between 40 and 60%. But 20% of the, 5% of the bars on any chart, the probability is very high that the market's going to do something. So when you get that, it's probably 70 or 80% chance we're going lower. But during all the other bars, even bull bars, the best the bulls can expect is a 60% chance we'll go up, 40% chance we'll go down. Same here, big bull bars, but it's not 70%. It's no more than 60%. Big bear bars, no more than 60% that we're going to go a lot lower. Bears, we have a micro double top, 2 and 4. We only had 1 bull body today. So actually, I'm wrong. Bar 3 has a small bull body. But do you want to? Is this bearish enough to sell below 4? I'm not going to. It looks like limit order traders are making money on every bar. We're far below the moving average, and we have 2 bull bars. So that means there are probably more buyers below 4, more buyers below 3 than sellers. What happens if 5 is also a big bear bar closing near its low? Then we get into what I said earlier. It doesn't matter if it's probably not going to be a big bear day. If it is starting to become a big bear day, I'm going to short. But right now, as I said, probably 60% probability we're going to have a trading range open. It's probably more like 80% chance it's going to be some kind of a trading range open. And at this point, we've reversed up on 1 after a big gap down, reversed down above below 2, below 4, reversed up above 3, trying to reverse up on 5. So every bar is reversing. And that means traders are not swing trading, they're scalping. How do you know that they're scalping? Because the market's reversing after every bar. And that means traders are not holding on to positions. And not only that, when it goes down, you have bulls eager to buy. When it goes up, you have bears eager to sell. Can you just buy below 4? If you're a scalper and you're comfortable making quick decisions, you can trade this like a limit order market. But most traders will lose money because at some point we'll get 2 bear bars, 3 bear bars, or 2 bull bars, 3 bull bars. And what do you do if you're on the wrong side? You have to make quick decisions, and quick decisions have a high probability of being wrong, so you can end up losing a lot of money. And you never want to lose a lot of money. You especially never want to lose a lot of money early in the day when the bars are big and when the legs are big. Because what happens is later in the day, the bars get smaller and the legs get smaller, and you can make less profit per contract. So if you lose a lot early in the day, later in the day, it becomes very difficult to make the money back. In the middle of the day, you start hoping to make half of the money back. And then you're just miserable all day. And trading, you want it to be profitable, but it also has to be fun. If you're going to be doing this for a living for a long time, you have to be enjoying what you're doing. And if you're spending the whole day trying to make back earlier losses and feeling miserable, that's not how to trade. It's better just to patiently wait. Even if you miss the initial trend trade, it's still better to patiently wait and not put yourself in a terrible position for the remainder of the day. Now, we're getting reversals. We have a lower high 4, a higher low 5. You can call it a triangle. We have a little bull doji 5, bull doji 3. I still think odds favor sideways to up. You can argue we're still on the buy above 3, we're still on the sell below 2 and below 4. But if you're a bear and you sold this far below the average price, how are you feeling if your entry bar 3 has a bull body, if your entry bar 5 has a bull body? Not good. And for the bulls, none of the 3 buy signal bars is as good as you want. Bar 1, tail. Bar 3, bar 5, dojis. Better to patiently wait. In situations like this, you end up often entering late. You're waiting for a couple strong bull bars and then buy, a couple consecutive strong bear bars and then sell. Or if you're lucky, it'll go sideways and you'll get a bull bar closing near its high, near the bottom of the range, or a bear bar closing near its low, near the top of the range, and near the moving average. Remember I said it usually takes about 15 bars of sideways trading before the average gets pulled down here. The average is based on 20 bars, and now 6 of the 20 bars are down here. And if we have 15 bars down here, then 15 of the 20 bars are down here. And that means most of the bars are down here, and that will pull the average down below the high of the day. Good sell signal bars, 2 and 4, but bad location. If we get a good buy signal bar, the location is good. So you'll get bulls more willing to buy than bears willing to sell. Once we get to the average price, the bears will look for a wedge or a double top, and then they'll look to sell a reversal down from the moving average. So if we get a rally to the moving average, the bears will look for a double top or a wedge top, and then a bear bar, and they'll look to sell for a swing down. And when you have a trading range open, it increases the chances, it reduces the chances of a big trend day. If the market's sideways for 10, 20, 30, 40 bars, it's probably not going to become a big trend for the remainder of the day. So if you do get a swing down, you'll have to assume it's not going to last all day. Swing down, reversal, swing down, reversal. If you get a swing up, it's probably not going to last all day. Swing up, sideways. Swing up here, it lasted most of the day, but sold off here. So trading range opens reduce the chance of big trend days. They do not reduce the chance of swings. We're probably going to get a swing, but the swing probably will not last all day. Still on the buy above 3, still on the sell below 2 and below 4. Market's deciding on the initial direction. And as I said, I think if we go down, it probably will not last all day. We're too far below the average price, and the market is hesitating. Usually, you're not going to get a big trend day or a big bear trend day. Remember, we're breaking below that May 20th low, and the bears are hoping that this is the start of a measured move down. We have a higher high double top, we're breaking below, and they want a 400-point measured move down. So it's possible we could fall far below. But what happened when we fell below the January low? Reversed up. What happened when we fell below the February low? We sold off and reversed up. And what happened below the May 2nd low? And we reversed down, next day gapped up above that close. What happened below the May 12th low? We sold off, reversed up. What's going to happen below the May 20th low? If we sell down, I'm assuming it'll do like it's been doing for the past 6 months and reverse. Below this low, reversed. Below this low, took a few days but reversed. Below this low, reversed. Now below this low, probably will reverse either today or the next few days, for example, with the FOMC meeting on Wednesday. That triggers the high 2 buy or the triangle buy. For the triangle, we have lower high 2 and 4, lower high 4. And for the bulls, we have higher low 6, or higher low 5 or 6. On a smaller time frame chart, this is probably a triangle. Here, it's a small double bottom, 3, 5, small double top, 2, 4. And now we're trying to get a third top, 7. So now on this chart, it is a triangle, 3 highs, 2 lows. 60-minute chart, we have another half hour before the bar closes. A trading range late and a bear trend is often a final bear flag and a magnet. So the bulls are hoping we get back up here by Wednesday's FOMC meeting. The bears obviously are hoping we break strongly below. But like I said, with all these other prior lows, well, this one we broke far below, but broke below that, reversed, below this, reversed, below this, sideways, below that, took a little while, reversed, below this, reversed. So probably not going to be a huge bear trend day. And even if it does begin as a big bear trend day like this, you got to be thinking reversal. Less likely we're going to collapse. Collapses and crashes happen, but they're rare. So is this more likely a crash or a minor sell-off that will lead to a reversal into a trading range or a bull trend? Crashes are rare, but they happen. At the time this was happening, this was a really big bar on the 5-minute chart. Back then, 10 points was big. But by the end of the day, that's what the bar looked like. And the market crashed, and there were many bars, many times bigger. This is the 87 crash. It fell 26% in one day. But right from the open, it sold off. Here's the financial crisis in 2008, and that crash fell 10% in less than an hour or so. Here, it fell 5% in a day. It rallied 28 points on the open, yet it still ended up falling 5% on the day. 5% is about 200 E-mini points. Another day, it fell 5%, a small pullback bear trend day. It never looked all that bearish. Trading range opened like today, and the bear breakout was not impressive. Yet at some point you have to conclude it's a small pullback bear trend and you have to sell. The easiest thing is to wait for a bear bar closing below its midpoint, closing there slow, and you just sell below it and then hold on. Pretty good rally, but it's fell 2% in a matter of a couple of hours. So this is a crash at the end of the day. And, it can crash up. People don't use the term crash when it goes up, but sometimes you can get crazy big moves. I really don't have a good example of anything comparable to what we had on the crash down on the 5-minute chart. But this is the dangerous one to trade. Trading range opened like today and just sold off. Here we have a couple consecutive bear bars closing near their lows. So that's really important. Bulls want a bull bar closing near its high. So possibly bar 8, although it's forcing traders to buy fairly high up in the range. And the bears want consecutive bear bars with decent sized bodies closing near their lows. So the bears are hoping, something like this. They want to get a pair of consecutive bear bars before they sell this far below the average price. Every bar today has at least one prominent tail, even bar 1 and bar 2. Bar 1 has both of those have prominent tails on top. And a tail means the market went one way and then the other way. So it went 2 different directions. So it was not relentless buying or selling. You can see the average price is falling quickly, even though we're going mostly sideways. Usually by around bar 15, certainly by bar 20. If you go sideways, the average price will be down to the bars by bar 20. It has to be because it's a 20-bar average, and if all 20 bars are here, the average will be here as well. Bears are hoping for a collapse. Go back to that crash, small pullback bear trend. The potential is there, but crashes are rare. So you have to assume this is not going to be a crash. I edited this chart a moment ago. Consecutive big bear bars closing near their lows. Possible breakout below the trading range and a sell to close bear trend. And it became a small pullback bear trend. A lot of small buyers, never looking all that bearish, but all the pullbacks were small. So a small pullback bear trend. So if you sell below 9, we're getting near the end of the first hour. If I'm selling this far below the average price, I usually want consecutive bear bars, preferably closing near their lows. Last week I talked about that over here. Basically a trading range, you can call it a bear channel, but once you've had a couple big bear bars closing near their lows, the market is probably beginning a trend down and possibly some kind of a measured move. And here we fell for more than a measured move based on the height of that trading range. We just kept selling off for the remainder of the day. That's what the bears want now. They want to get a sign of relentless selling. So far today, we're getting reversals every bar. The bears want 10 minutes of no reversals. That would be a sign of relentless selling, and it would increase the chances that we'll go lower. The market is starting to think about how the first 60-minute bar will look. Is it going to be a big bear bar closing on its low? Or is it going to be a small bear bar? Is it going to be a bull bar? Is it going to have tails top and bottom? Still on the sell below 2. 2 so far is still the high of the day. I did not sell below 2. I did not sell below 4. We're below the Globex low. Where's the next support? On the daily chart, you don't see any additional support. I could do this and look. All of these lows are support, but really you don't get anything until you start getting down near the pre-pandemic high, that or the February or September high, 3,500, 3,300 on the daily chart. I don't have the measured moves drawn in on the daily chart, but those are potential support as well. We have a double top here, higher high double top, so a possible measured move down. I always first create the measured move based upon the lower of the two highs. If it goes below that, then I'll switch and look at a measured move from the higher of the two highs. So measured move, you can say either based on the height of a trading range or a higher high double top. Here, a higher high double top. So there is a cluster of support around the February high and a few hundred points higher. So this is the next support zone. If we fail at this support zone, we're below the May 20th low, but it still could be support. We could still reverse up from below it. Very good bar for the bears. Can they get a second consecutive bear bar closing near its low? If they do, that will increase the chances that this is the start of a bear trend. This is what they want, a bear trend lasting all day. And this is where we are now. Trading range open. The bears like to get a couple consecutive bear bars closing near their lows. Here, again, another couple consecutive decent bear bars closing near their lows. Here, a few more bear bars closing near their lows. When you get multiple instances of relentless strong selling, it increases the chances that the bear trend will last all day. Does it sell the market, sell the close? On a smaller time frame chart, it is. A 2-minute chart, 1-minute chart, 3-minute chart. But on this chart, the bears would like a second consecutive bear bar closing near its low, so possibly bar 10. And your stop would be above 7. So 30 points up. If you take the trade, you have to trade small. And as I said, small means, for me, small means 20% of a normal position size. If you normally trade 5 E-minis, then you'd sell 1 E-mini. If you normally trade 5 micro E-minis, or you'd sell 1 micro E-mini. More traders selling, betting that this is going to be a big bear trend day. Remember, I said 20% chance it would be a big bear trend day. And it could be a very big bear trend day. What happens if 10 has a fairly conspicuous tail below? Then a lot of the bears will not sell the close. They'll wait. What is a conspicuous tail? Well, the bars are big, so the tail would probably have to be 5 points or more to make bears not want to sell the close of 10. And anybody who's selling, whether you're selling at the market or selling below 9 or selling below 10 or selling the close of 10, your stop initially is above 7. You will get out before that stop gets hit, but that's where you put your initial stop. For example, okay, so that's good, sell the close. But for example, let's say 11 is a bull bar closing near its high. Possible bear trap. Bears should get out above a bull bar closing near its high. So if 11 is a bull bar closing near its high, instead of getting out above 7, I would get out above 11, just in case this is a bear trap and that we begin a reversal up from here. If you get out, you can always sell again, either below a bear bar closing near its low or at a new low on the stop below 10. Everything is big. It looks small, but it's big. So if you're trading, I would trade 20% normal size. And you can add on if the market continues your way. Getting to the end of the first hour, the market often tries to get a reversal on bar 12, sometimes bar 11, making the first bar either less bearish or less bullish. Here, the first bar is a bear bar. So the bulls would like 11 and or 12 to be bull bars to make the first 60-minute bar less bearish. Can you get long above 11? I would not. We have a bear surprise 9-10. We should get at least a small second leg sideways to down. So I would wait for a second reversal up before getting long. Reasonable to get out of shorts above a bull bar closing above its midpoint. Reasonable to get out of shorts above any bar, 5 points above any bar, so above 10 or above 11. Let's say 11 has a small bull body, and still get out, maybe 5 points above its high. Trading range open for the first 8 bars. We're breaking below, so the market will probably try to get at least down for measured move, a little bit below where we are. Part of this hesitation is from bears who sold the close of 9, taking partial profits at 10 points. There probably will be other profit takers at the measured move down here. Not only is that a measured move, it's also about 10 points below 10. So some of the traders who sold the close of 10 might take partial profits at 10 points. 3 consecutive bear bars, very good bear surprise. We should get at least a small second leg down. But just in case this is a bear trap and we reverse up, I would get out maybe 5 points above 11. If 11 turns out to be a huge bull bar, you don't want to get out up here, 30 points above. So it's better to get out early. You can always sell again if you exit. Bar 12 often reverses, making the 60-minute bar less bearish. Double top here, measure move here. If we fall below that, instead of looking at a measure move from here, I'll look at a measure move from there, the higher of the 2 highs in the double top. Hesitating on bar 12 is often profit taking on bar 12 if there's a strong bull or bear trend. Here we have a strong bear trend. Can you buy the market and scale in lower, betting that we're too oversold? I would not do that. Some computers might be doing that, but I think it's too early to buy. Strong enough bear surprise, 9, 10, 11, probably will get at least a small second leg down. So better not to buy until we've had at least a micro double bottom or a second reversal up. We do not even have a first reversal up. So 9, 10, 11, the bulls will want 2 reversals up. To still sell the close, sell the market. Get out 5 points above any bar. Is this going to last all day? Are we going to do this small pullback bear trend day all day? Probably not, because these days, a huge bear day like that, 5% in a day, is rare. And small pullback bear trends, most of the time, do not last all day. So those 2 facts make it more likely than not that this is not going to remain a small pullback bear trend. So the bears are hoping, or the bulls are hoping, this is a bear trap, the opposite of the bull trap we had a couple of days ago over here. We had a couple bull bars and it became the high of the day. Now we have 3 bear bars. The bulls are hoping it'll be the low of the day. But strong enough sell up, better to wait for a second reversal up or for 2 or 3 bull bars and then buy. Okay, a bull bar, a failed bear breakout, but not a good enough bull bar to buy above 12. Bears, they can either get out above 12 or they can get out a certain number of points above 12. Pick a number, 2 points, 4 points, 5 points, 10 points. If you do get out, you can always sell again at a new low below 12 or below a bear bar, maybe bar 13. You can see so far, not a lot of bears bought back shorts above 12. The first hour, I messed that up. The first hour was a big bear bar closing near its low, similar to the first hour on Friday. And usually the market will try to go at least a little bit below that bar. And on Friday, that's all that happened. We went a little bit below and then sideways to up for the remainder of the day. Bear bar here, went a little bit below. Bear bar here, a little bit below. So will we go a lot below or a little bit below? As I said, we're oversold coming into the day. We have a really important event that could lead to a big move up or down on Wednesday. And all of that reduces the chances of today continuing down as a big bear trend day. Right now, it's a decent bear trend day, a small pullback bear trend. We just went below the low of bar 12, and that means we just went below the low of the 60-minute bar. And sell the closed bears. Are traders selling the close of that first bar? Are they selling with a stop below the low of the bar? Well, we'll find out. Are we going to break below, far below 12? That would increase the chances of more bear bars on the 60-minute chart. It's better for the bears if we do not get a series of big bear bars over the next few bars. Because if we get that, then we'll probably end up with exhausted bears unwilling to sell at the low. They'll look for pullbacks to sell. Most of the time, when you get a strong trend on the open, this is what happens. Okay, so a bear trend on the open, 3 examples. 20% of the time, it lasts all day. 20% of the time, you get a bull trend reversal. 60% of the time, the trend just stops and you convert into some kind of a trading range. So this is what is likely today. Right now, we might be at this point. We might be at this point. We don't know. But most of the time, when you get a small pullback bear trend, even with big bear bars, you end up with exhausted bears and they want a pullback to sell. They stop selling at the low and the market ends up going mostly sideways. Big sell-off, tried to reverse, failed, ended up going sideways. Sell off, sell off, sell off, and then sideways. Lots and lots of examples, and that's because it's a very common pattern. And when you get the reversals, the first reversal up is minor. Very strong reversal, but did not lead to a bull trend. Minor reversal. Very strong reversal up, minor. After a strong sell-off, it led to a trading range, not a bull trend. And here, if we get a strong reversal up, probably minor. Looks like more buyers than sellers below that first 60-minute bar. Remember, I'm not strongly bearish. I still think the odds are against this being a bear trend day that lasts all day. And that means I expect a trading range or a reversal. And outside up, good for the bulls, but not good enough to bet on a reversal. What happens if 13 closes on its high? Well, then we'll have consecutive bull bars, one being big and closing on its high. It would be by the close. 13 is not big enough, so I would not buy. But it creates a problem for the bears. It's a decent bar. It closed above 12. If the bears did not get out above 12, I would get out above 13. You can always sell again, either below a bear bar, maybe 14 or 15, or at a new low. And for the bulls, a possible low of the day, but a relatively strong sell-off, probably a minor reversal. So better to not buy yet. Bears, I'd get out of shorts, but bulls, I think the math is not all that good to buy yet. Low 114, small pullback bear trend. But to sell below 14, you're still selling far below the average price. So you would need a pretty good bear bar. You have sell to close bears 9, 10, 11, disappointed 12, and it looks like many who sold the 11 close or the 11 low got out break even on 13. Taking just under concern that this could be below the day. A micro double bottom, down on 12, up on 12, down on 13, up on 13. On a smaller time frame chart, it has to be a micro double bottom. But on this chart, the 5-minute chart, it's not yet a very good buy for stop entry traders. Limit order traders, it looks like they bought below 11, they bought below 12. Stop order traders, you get some bears exiting above 12, above 13, but not many bulls buying yet. It's still probably only a minor reversal up after those 3 big bear bars down. Now, what happens if the pullback grows? At some point, it's no longer a small pullback. Right now, it's still a small pullback bear trend. But if we get bigger bull bars, more bull bars, if we start getting up near the breakout point, the 3 low, then it's no longer a small pullback bear trend. It could still be a bear channel, but it would not be a small pullback bear trend. Remember, coming into the day, I said 20% chance of a big bear trend day. It's a little bit better than that now that we see 9, 10, 11, but maybe it's only a 30% chance that this is going to remain a strong bear trend day and continue down. We should get at least one more small leg sideways to down. It's possible that 13 is all we get, but pretty impressive bear bars, so probably we'll go a little bit lower. A low 1, but far below the average price, and it's only a doji bar, and it's following 2 bull bars. So that's not going to attract a lot of bears. So you can sell it for a swing. I would not sell it for a scalp. We may go sideways more here. And for the bulls who bought above 13, the stop is still below 13, and there probably are more buyers than sellers below 13. We might be starting to form a tight trading range. So this is lower probability stop entry trading, buying above 12, above 13, selling below 11, selling below 12, selling below 14. Best price for most traders right here, back to flat. Second best choice, short. And third best choice, I still think it's too early to get long. Good bar for the bears. You can see traders are now selling a second break below the first hour. Bar 12 is below the first hour. And it triggered the sell when 13 went below 12, but not many traders sold. And they are selling now. That fulfills the minimum expectation of at least a small second leg sideways to down. Will the bears buy back shorts? Will we get a reversal up, wedge, 3, 13, or will it resume sell to close trading? And still sell to close, but I think it's probably better to wait. If you do sell to close, stop above 14, you have to trade very, very small. possible parabolic wedge. Remember I said that when you have these big gaps down on the open, the bulls try to get some kind of a wedge reversal, a fairly tight channel that's still reversed up. Bears are hoping for some kind of a wedge reversal. Many different versions of it. I said it's not worth buying above 12.13, but if 16 is a bull bar, then you'd have to be thinking this is possibly a parabolic wedge, 3 reversals up and a tight bear channel. To buy above 16, the bulls will need as good a bull bar as they can get. And the bears instead are hoping that the small pullback bear trend will continue. I'm going to get rid of this measured move. The market is ignoring it. Different versions of wedge bottoms. If it's a fairly tight bear channel and the legs are not as clear, it still could be a parabolic wedge reversal. Leg down, pause, leg down. A doji bar, pause, and then leg down. And similar thing here, leg down, pause, and third leg down, reverse up. Same thing here, leg down, pause, down and up, and then third leg down and up. Still sell for any reason, but we're also in a time window when if there's going to be a reversal, it's common for reversals to come 16 and afterwards, around bar 18. What happens if you're selling the market right here? It's the same thing. Get out a tick above a bull bar closing near its high, 13, or 5 points above any bar, bull or bear bar. And if we get a pretty good looking bull bar, not only do bears get out, but bulls will buy, betting on a parabolic wedge, 3, you can go 3.11 or 3.13. What happens if 16 has a small bear body, but closes near its high? I think most bulls will want to see a bull bar closing near its high. Otherwise, traders will keep selling, sell the market, sell the close, sell below the low of the prior bar. This is bar 16. Remember I said around bar 15, the moving average will be based mostly on these bars, and the average will be below the high of the day, which it is. Sometimes people ask me about Bitcoin, and I question its reason for existence. Here's a daily chart. And so even though I still trade it, I haven't traded it recently, but I'm still willing to trade it. Fundamentally, I just don't believe the story that the supporters of cryptocurrencies are making. It's just not credible. And they were talking about here's Bitcoin right now. This is okay, this is actually Bitcoin down to $23. And the bulls keep saying, well, we've had these big sell-offs before. When I look at this chart, this is a weekly chart, it looks like it's going down here. We have a double top, a neckline, we're breaking below it, we pull back. So it looks like it's going back down here. Bulls trying to get a parabolic wedge, possible low of the day. So pay attention. The more bullish 17 is, the more bulls will buy above 17, taking a chance it's a parabolic wedge bottom. You can always trade small, bars 10 points big. You can buy more higher. And bears, I would get out 5 points above 16, 1 tick above 17 if 17 closes near its high. Remember I talked about parabolic wedge bottoms, big sell-off, 3 legs down, lots of versions of it. Even if the sell-off is big, you can still get a low of the day. Okay, why do I have so many versions of it? Because it's a common pattern. This is similar to today. Sideways and then a parabolic wedge, low of the day. So lots and lots and lots of copies of patterns, lots and lots of examples. What happens if 17 is a bull body, but a fairly prominent tail? I still get out of shorts above because of the parabolic wedge, and bulls will start to buy. Some bulls will buy, some bulls will buy small. Other bulls will wait to see if we get a second consecutive bull bar and then buy. Possible low of the day, so I would get out of shorts and reasonable buy for a swing up. Sometimes you wonder, are we going to get one more leg down? Right now we have 1, 2, and 3. Was this strong enough to start the count over again? So is it now 1, pull back 2, pull back 3? And sometimes that's the case. So you trade small, then you have 2 choices. You either exit below 17 and wait to buy again if we get a second reversal up, or you hold and just use a wide stop and possibly buy more on a third reversal up. And for the bears, is it similar to 14? I'm not going to short below 18. We got a parabolic wedge. We're far below the average price. We've got decent bull bar 13, decent bull bar 17. We're in a window where the market often tries to reverse around bar 18. Is it still sell to close? Yeah, it's still a sell to close bear trend. You know, bears, if 18 collapses, they'll sell below 17. 17 is a pullback, so they'll sell below 17. And otherwise, they'll wait for 18 and sell below 18. And bulls, if 18 is a bear bar, do they get out below 18 or below 17? If it's a bear bar closing near its low, it's okay to get out below 18. It's okay to get out below 17. But I suspect that if we go below 17, we'll get another reversal up within a few bars. So I think the downside from here, the probability of a lot of downside from here is not great. It looks to me like the market is trying to get a climactic reversal. Parabolic wedge, any kind of a wedge bottom is a type of sell climax. Back to Bitcoin. I have many problems with it. You cannot, it still, I think, only gets 7 to 10 transactions a second, and that's just too slow to be a currency. You know, Visa and MasterCard can process thousands of transactions a second. And also, Bitcoin is still too easy for criminals to use, and society does not want things to be easy for criminals. So that's another problem with Bitcoin. And third, governments don't want any big financial thing in existence that is out of their control. So it makes more sense to me that if we're going to get some kind of a cryptocurrency, that there'll be one major cryptocurrency run by governments, maybe the United States and Europe, and they'll have control and they'll have the ability to trace transactions, and they'll get rid of a lot of the anonymity and make it difficult for criminals to use it. So I have other problems as well, but I think Bitcoin is a bad product. It could change, and governments could start to try to regulate it. So instead of the governments creating their own currency, they might try to create enough regulations so that the criminal element is no longer a problem. All right, so for the bears, another low one, like 14. The more 18 closes near its low, the more bears will sell. Now, I think we're probably either going to try to get a reversal up 17 or maybe one more leg down and reverse up from below 17. So the bears selling below 18, you're in a strong bear trend, you can sell, but there probably are buyers not too far below. So it's a lower probability trade. So if you're selling it, you're hoping that we're going to be in a small pullback bear trend that lasts all day. So if you sell below 18, you're swing trading, looking for 20 points, 30 points. And for the bulls, I would not get out below 18. I think you can get out below 17. I think you could probably use a wide stop and not get out below 17. Most traders, it's usually better to get out when they think they might be wrong. So either below 17 or below 18, and then wait for another buy signal before buying again. Bulls trying to prevent their stop from getting run below 17, so they're trying to buy here and create a higher low double bottom or a perfect double bottom. So this is really interesting, Can the bulls prevent their stop from getting run? Can they prevent 19 from falling below 17? If they do, that would be a sign of strength, and it would increase the chances that we're going up. If we do go up, how high will we go up? My first two targets are always the same. The top of the most recent leg down, so 14, and the moving average. And usually they end up around the same price. And the bears get another strong leg down, like 15, like 9, 10, 11. Or will the bulls get a second reversal up, 19 or 20? Is this going to be a parabolic wedge bottom, or is the small pullback bear trend going to continue? The bears who sold below 18 or below 17, again, they'll get out if we get a bull bar closing near its high. And they'll also get out a certain number of points above any bar, above 19 or above 18. Still sell for any reason. I'd get out above 18 or above a bull bar, maybe 20. I still think it's more likely we're going to get a reversal. And because it's more likely we're going to get a reversal, if you're selling, it's a lower probability trade, and you have to go for a big reward. So for the bears, they cannot sell here for a 5-point scalp. If they sell here, they're looking for a 20-point swing down, 20 or more points. I'm going to turn the screen off for a second. I want to add something to my toolbar. I'm going to turn the screen off for a second. I want to add something to my toolbar. I'm still working on my toolbar. Okay, finished. All right. All right. Parabolic wedge now, 12.17. There's, a tick above a bull bar on 20. And for the bulls, they still want to buy. They still are hoping for the parabolic wedge, but they want a pretty good bull bar. If they get a bar that looks like 12, they'll wait for a second bull bar, 13. The bulls who bought above 17 with a small position, they'll buy more above 20 if it's a bull bar. If it's only a 1 or 2 tick bull body, I think bulls will wait. Still sell the market, sell the close. I'd get out 5 points above 20, and for the bulls, it's not a good enough buy. I said I had other problems with Bitcoin. And another one is, I don't know if you remember, a couple of years ago, all the Bitcoin people were saying, it's digital gold, it's digital gold, it's just like gold. And, well, let's take a look at gold. Here's a weekly chart of, gold. And let's sort of a weekly chart of Bitcoin and see if it looks just like that. Weekly chart of Bitcoin, or a daily chart. Here's the daily chart of Bitcoin. Here's the daily chart of gold. Okay. Daily gold, it's selling off for a few months, but does it look like this? Here we started selling off in October in Bitcoin, and in gold, we were rallying until February. So the idea that Bitcoin is digital gold is nonsense. When gold was going up strongly during a panic, Bitcoin was going down. Here's gold, and here's Bitcoin. So, you do not hear the Bitcoin idiots talking anymore about Bitcoin being digital gold, right? Because it's clearly not something that people run to when they're panicking and they're trying to preserve capital. So it's not a safe haven. So that was one of the big arguments in favor of Bitcoin when Bitcoin started to become popular a few years ago. But you don't hear that argument anymore. And the reason why you don't hear that argument anymore is because it's clearly wrong. So now the Bitcoin people will try to come out with other reasons why you have to buy Bitcoin. I still have not heard any reason to buy Bitcoin that makes any sense to me. Reasons why you have to buy Bitcoin. I still have not heard any reason to buy Bitcoin that makes any sense to me. Reasonable for bears to get out of shorts 5 points above 20. And bulls, do they buy above 20? I think most bulls would like to buy above a bull bar closing near its high, so they might buy above 21. We're still in a small pullback bear trend. However, the bears who sold below 18 are back to break even, and the bears who sold below 17 are holding a loss. And the limit order bulls who bought the 18 low or bought the 17 low are starting to make money. So this looks like it's a parabolic wedge bottom. And for the bulls buying above 21, big bar, so big risk, and tight channel, so the probability is not as high. It's still probably a minor reversal. However, I would either be long above 17 or above 21, or get flat, get out of shorts. Can this be a big bull trend day? It's possible, right? The bulls who are buying here are betting that we're going to rally for at least an hour or two. So, as I said, the target is typically, first target, the top of the most recent leg down, 14 high, and around the moving average. I'm doing different things going on here. I did buy above 17. I held long. I bought more during 21, early in 21. I just took part of my position off. So now my average entry price is very good. It's down here. However, if it becomes strongly bullish, I'll buy more. But anyway, I made trades in several accounts, doing several different things, including buying stock. Probably a minor reversal up, but the context is very good, for at least an hour or two of a rally. Impressive consecutive bull bars closing near their highs. I would not be surprised if we totally reverse the day and get back up to the May 20th low. Remember, I said that I thought the market's getting fairly oversold, and we may have to bounce and get more neutral ahead of Wednesday's FOMC meeting. Very strong reversal up. Probably, we've seen the low of the day. Big enough bull surprise. Traders will buy the first reversal down. Reasonable to take some profits off here. Remember, I said my first target was the 14 high in the moving average, and I said they usually will be around the same price. We may get back to above that May 20th low late in the day, end of the day. Now, for the bears, is it a 20 gap bar sell signal? Yeah, it's been 20 bars below the moving average, but it's following a very good bull surprise and a parabolic wedge in an oversold market. So most bears should not sell below 24. They should wait for a second sell, micro double top. You can see bulls taking profits around the moving average. You look at 23 and you say, wow, that was a big bar. However, I said we should get a swing up 20 points or more, and the bulls who bought were able to get 20 points. The bulls who bought above 17 and used a wide stop and bought more have a pretty good profit. The bulls who get out below 18 or 17 and then bought above 21 more than made up their loss. Is there any reason to sell 24 double top at the moving average 20 gap bar sell? Too much of a bull surprise, probably a major bull surprise. That means it more likely will affect the entire day and not just the next few bars. So while it's reasonable to get out of longs below a bear bar closing below its midpoint, it's not worth shorting at this point. I would wait for at least a second sell signal. Reasonable for bulls to either exit or take some profits below bar 24, the bear bar closing near its low, a 20 gap bar sell, a double top 14. But I think it's a big enough bull surprise so that a reversal down from here will be minor. 20 bad buy signal bar, bear bar. So we may come all the way down to the 20 high over the next hour or two. But a big enough bull surprise, good enough context, so that I think we're probably not going to go much below 21 if we go below 21. Right now, probably 60% chance this is the low of the day. If we start to get 2, 3, 4 bear bars here, then instead of 60%, it becomes 50, 40, 30. we may have to test the 20 high because it's a bad buy signal mark. Some bulls will look to buy a 50% pullback. Bulls will look to buy a 50% pullback. So around here, around the 18 high, the breakout point. Other bulls, instead of buying with limit orders, will wait for a reversal up and a higher low and then buy again. Bulls high 125, but big bar, so big risk, following a big bear bar, so lower probability. Right below the moving average, so lower probability. You can see the low of the bar is almost exactly a 50% retracement. That tells you that there were a lot of buy limit orders, 50% down, bulls looking to buy a pullback. What do you do here? It's okay to be long. As I said, I think it's reasonable to exit, take some profits around 20 points, around the 14 high, around the moving average. And do you buy back above 25? I would not. I'd wait for a second buy after the big bear bar plus the big buy signal bar 25 right below the moving average. So not a strong buy. You can always buy small, but I think there's too much risk of more of a pullback. High one after a major bull surprise, but only a doji following a big bear bar and at the moving average. That combination will reduce the number of bulls buying above 25. We're around a 50% pullback of the sell-off. Possible micro double top 24, wedge 14.24, but probably we've seen the low of the day. The bears would need a very good sell signal bar, 26 or 27, to attract sellers. Bulls trying to get a breakout above 24 and a measured move up, which would get us back above that May 20th low. And I think that's where the market is trying to go, back above that May 20th low. The big bear bar 24 increases the chances that will stall around where we are, but it's still buy for any reason. The bulls are hoping for a very strong reversal up. So why am I not all that confident that we're going to get a big bull trend day? Well, we've sold off strongly for several days. We have uncertainty, FOMC, on Wednesday. And we have bad follow through 24, weak buy signal bar 25. So that both of those, all of that, plus a pullback to the moving average, all of that increases the chances that we're going to stall here. We've probably seen the low of the day. The bulls have a chance of a new high of the day, but I don't think we'll get there. I think more likely we've seen both the high and the low. The bears want to get back down to the 20 high. Some bears sold the 20 high, sold more higher, and they're hoping to get down to the 20 high. If not there, they want to get halfway down. So they sold the 20 high, they sold more below 24, and this is their average price. They want to get down to their average price so that they can exit without a loss. I said not good to sell below 24, but bears would sell a second reversal down, 27. Bulls, if 27 is a bear bar closing below its midpoint, I'd get out below. And for the bears, it's probably a minor reversal. So if you're selling, you have to be pretty quick to get out. You only sell if you're hoping that we're going to get a swing down. And chances are we will not after such a big bull surprise, 21, 22, 23. Chances are it'll be a minor reversal, maybe to the 25 low. Confusion. The bears have a higher high double top. They have a wedge, a 20 gap bar sell, a 50% retracement of this sell-off, and the bulls have a very strong reversal up. Confusion often leads to a trading range. Bulls trying to get as many bull bars closing on their highs as they can. They're hoping that this will be a big bull trend reversal day. Remember, coming into the day, I said today would probably not be a big bear day. That if we sold off, we'd either get a reversal or a trading range. How bullish will 27 be? The more it closes on high, the more traders will bet on a strong bull trend. The bigger the tail, the more traders will bet on a weak bull trend, and that will start to go sideways here. Big enough tail, it will reduce the number of buy the closed bulls. Bulls, they can get out a few points below any bar, 27, or below a bear bar closing near its low. And for the bears, a low 2, 24, a wedge 14, 24, a 20 gap bar sell, 50% pullback, a breakout test 3 low, but probably a minor reversal, maybe a trading range down to the 25 low. Remember back here, there's a limit order market trading range open. Some bulls bought the 5 low and used a very wide stop and bought more above a bull bar closing near its high, 13 and or 17 and or 20, betting that it would come back to at least their average price and possibly their first buy at the 7 low, which it just did. And therefore you'll have bulls selling at the 7 low, and that's what's causing this reversal. The bears know the bulls will do that, so the bears are selling here as well. Minor reversal. The bulls see that they could make money using a wide stop and scaling in, and therefore they'll be interested in buying a sell-off over the next few bars. And the bears see how strong the market reversed up, and therefore they're not willing to bet on a bear trend, and therefore they'll take quick profits. A bull bar 27, some bulls buy 27 low, buy more 5 points lower, 10 points lower, 15 points lower. And for the bears, not a good sell signal below 27 or below 28 for that matter. I'm still long part of my position, but only a small part. I'm looking to buy again, but I'm not going to buy above 28, possible parabolic wedge, 23, 27. So I'm stuck on the sidelines, waiting for a couple legs sideways to down before buying again. I won 28, strong reversal up, but bear bar and possible wedge 23, 27. Might be more sellers than buyers. Above 28, above 27, and at the open of the day. Nobody wanted to buy above 28, third leg up, possible wedge, a bear body. So now bulls are taking profits and look to buy again, maybe a double bottom 25. And bears, not a very good looking sell, below bull bar 27 or below tail 28. Looks like we're probably going down here, but difficult to sell with stop orders. Still always long and difficult to sell. So for the bears, I think I would just wait. And for the bulls, it looks like we might get a couple legs down. So I'm not buying above 29 and probably not above 30. Might get a couple legs sideways to down after wedge 14, 24, 50% pullback, 20 gap bar sell. But I think always in long, and probably buyers below around 25 low. So the bulls a high one, 28, 29, but two bear bars, decent bear bodies. So not a good buy above 29. Bulls trying to create a better buy 30, and it's a high one and a bull trend. But after the two bear bars and the location, 50% pullback, moving average, not good. Anybody, so it's probably better not to buy above 30. If you buy above 30, I think you need a wide stop, maybe below 25. Chances are we're going to get a second leg sideways to down. Can you sell below 29? 20 gap bar sell, 50% pullback, a wedge. I would not. I think it'll probably be a minor reversal. Bears low 130. They're hoping that 28 is the start of a trend resumption down, but it's a bull bar. We're always in long, probably buyers below 30. And for the bulls, a high 130, possible small pullback bull trend, but too many bear bars at resistance. Better to wait for a second buy. As I said, if you buy above 30, I would trade small and use a wide stop. Probably have seen the low of the day, and I suspect we may have seen the high of the day as well. But a major reversal, major bull surprise like this, we should have at least a couple hours of sideways to up trading. So if we trade down, we'll probably get a bounce in our trading range instead of a resumption of the bear trend. And the bulls are hoping this is going to be a really big bull trend, but 24, 28, 29 reduce the chances that this is going to be a big bull trend. It makes it more neutral. So what are we going to do? This is probably not going to be the final high, but we may have to come down here before we get a second leg up. So it could be leg one and then pull back for 5 or 10 bars and then an attempt at leg two. I'm still long part of my position, and I may hold it. I'll probably hold it until, unless we get a credible sell signal. And I am looking to buy more, but I did not buy above 30. Yeah, we had a bear trend from the open, and then a parabolic wedge reversal, and a pretty major bull surprise. That usually prevents the day from becoming a bear trend day. And we got a reversal up, and the day has been in a trading range. We have a lower high, we have a higher low, so we have a triangle. The bears are trying to get a successful breakout of the triangle. They'd like the day to close on the low, far below the May 20th low, the breakout point on the daily chart. And the bulls would like the day to close at or above the open, so that today would be a credible buy signal bar for tomorrow. And right now we're just getting a lot of reversals without really good signal bars. Selling below 52 or below 54, not good. Selling below 38, not good. Buying above 50, reasonable. Now, what about reasonable bulls buying 38 close? Let me talk about reasonable bulls buying 52 close. Disappointed 53. They were able to get out with a small loss, 54, at least theoretically. That's not the case for the bulls who bought 38. So theoretically, you have some bulls who bought the 38 close, and they bought more above a bull bar. 44, bull bar closing near its high. 80% chance it's going to get at least to the midpoint of the two buys, and it did. So 80% chance if you have a reasonable buy the close bar that if you buy above a bull bar closing near its high after a sell-off, it'll get at least to the average price. And that would allow these bulls to exit without a loss. If they bought here and bought more here, that's their average price. They could get out there and avoid a loss. Now we have another, this is now a double bottom 25 and a wedge 53 58, and we're getting a lot of reversals today. So chances are the market's going to try to reverse here. Can you buy for a swing? Is it a swing buy or a scalp buy? All of these reversals are low probability. They're not all that great. What happens is traders take them and hope that we get a swing up or down, and then they quickly become disappointed and they scalp out. So if you sold below 39, you probably scalped out about 44. If you bought above 50, you scalped out maybe below the bear bar 53. I would not buy above 56, but it's a buy above 61, but not a really good buy. It's a bear bar just below the moving average, lowers the probability, and the bar is big, and that increases the risk. So we're just getting a lot of trading range trading, which is how the day began. A lot of early trading range trading. Can you sell here? Given that we're in a trading range day, in general, I don't want to sell too low, so I would not sell below 59. I would not sell below the double bottom 61. And but to buy, I'd like to get. I was hoping that we would get a bull bar closing near its high and a smaller bar. Instead, we got a bear bar and a bigger bar. So it makes me not want to buy above 61. So better to be patient. It's easy to get eager and just take a lot of trades that are not quite good enough. But that's really, I think, a bad way to trade. It's better simply to do nothing and wait until you get something decent, like buying above 56. For selling on the way down, I did not sell below 39, but you can see 41, traders started to sell aggressively. So if you sell 41 or 42, you still could have made 10 points. So entering late is okay. Buying above 21, you're buying fairly high up, but that's still okay. The context is good. A sell climax in a parabolic wedge. Can you buy above 62 if it's a bull bar closing near its high? I think we made too high up. When you have triangles like this, you can say, wow, we're broke out below the bottom of the triangle. Well, it's a breakout mode pattern, and every time there's a breakout mode pattern, 50% of the time, you're going to get a reversal. The breakout will fail. And we tried to break below the triangle here and again here, and we're reversing up, but really not a very good looking buy signal bar. A lot of times if I'm not in the room, I'll scalp, and what I most often look at is a 2-minute chart. I like to scalp on the 2-minute chart. And in chat room days, I usually just look at the 5-minute chart, although I was aware of this on the 2-minute chart. A wedge, 3 reversals up, 1, 2, 3, and I just did not take it. You can also argue expanding triangle, 1, 2, 3, 4, 5. You can call it a lower low double bottom. You can call it a double bottom with this low. So there were reasons to take it. And if this was not a chat room day, I probably would have bought above that 2-minute bar. But chat room day, I don't want to be doing too many things. I already have placed trades in several accounts today, and I still have positions on. I'm still slightly long in one of my accounts from down here, and I expect that I'll hold long all day unless we collapse. And I did not buy above this. So right now, on the chat room, my E-mini account on flat. We're getting higher lows. We have a double bottom, but basically a double bottom, higher low, and a triangle. For the bears, it's not a very good sell below 63. A triangle is neutral. That means it's about 50-50 chance that will break to the downside, 50-50 chance it will break to the upside. I think the probability is slightly better for the bulls, both because of the strength of this reversal and because the market is so oversold. But it's not much better than 50-50. For the bears, I'm not willing to sell below 63. Probably more buyers below 63. What the bulls need is a good buy signal bar, 65 or 66. And for the bears, they don't have a good sell signal bar. And they're being forced to sell just above the double bottom. So that's not a good combination. So I think better to do nothing and hope that we get a good buy signal bar in the next few bars, or get a small double top with 63 with a good sell signal bar, or get a strong breakout below 61 and then sell below. But right now, it's the apex of a triangle, and that's bad math. Small reward, you expect reversals, relatively big risk compared to the reward, and low probability. Especially at the apex of the triangle, the reversals come faster. Instead of 5 or 10 bars before a reversal, now we're at the point where it's 2 or 3 bars. Bears want the day to close on a slow, so they obviously want a break below the double bottom, and the bulls want a reversal up, and for the day to close above the open. 3 consecutive bear bars, normally reasonable sell to close, but the location is bad. So not great for sell to close. Better to wait for a strong breakout and then sell lower. For the bears, they're hoping we get the breakout below the double bottom. And the bulls are hoping this is just a test of the double bottom. So I'll pull back from a reversal up from a double bottom. So it's a double bottom pullback. But with 3 bear bars, increasing body size, increasing bear bodies, the bulls will want a good buy signal bar, 67. The bears want as big a bear bar as they can get, closing on a slow. That will increase the chances that we're going down to the low of the day. And the bulls are hoping it's a failed breakout below double bottom. It would then be a high 2, 61, or a bigger high 2, 50. Failed breakout, but a big tail after 3 bear bars. So I think it's still 50-50, 50-50 chance we're going to reverse up, 50-50 chance 68 is a pullback from the breakout, and then it will form a low 1. No rush, right? We're probably not going to get a strong trend in either direction. We're right in the middle of the 2, I think, important targets, the open of the day and the low of the day. We're almost exactly in between the 2. So here's the open of the day, and there's the low of the day, and this is where we are. Here's the midpoint. Bears, do they get out above 67 if they sold below 61 or below 66? I think they could hold short because it's not a good buy signal bar. But if it goes back above 67 again or above 68, I would get out of shorts. And for the bulls, it's not a good enough buy signal bar after 3 bear bars. So right now we're probably always in short, but the location is bad. We're at the bottom of a trading range, bottom of a triangle. Market's still deciding, are we going to go down here or back up here? Micro double bottom. Bulls need a good buy signal bar. Can you just buy above 68, the neckline of the micro double bottom? I think it's probably better to wait for a better buy signal bar. And for the bears, if I had to be long or short now, I'd be short. Stop above 68. So I think it's more bearish than bullish, but it's not strongly bearish. Bears are hoping that this is the start of a move down. Because of all the reversals, we had a lot of reversals on the open. And when you get a lot of reversals on the open, it's a sign that traders are not certain. And it increases the chances that you'll have a lot of trading range trading for the remainder of the day. And since 24, we've been getting reversals pretty regularly. Here, every bar or 2, we had a couple better legs here, down and up, but mostly reversing. So it's a lot of work for not much profit. Can you just buy at the market and put a stop a few points below 68? You probably can, but I think it's better to look to buy above a decent bull bar. Big bear bar closing below the double bottom, but not closing below 67, so it's not as bearish as it could be. We still might get a reversal up. Remember early on, I said 20 was a bad buy signal bar, and therefore you'd have scale in bears selling above 20, and that we might get back down there. And that's what might be going on here. We may be trying to get down to that 20 high. I just got out of my remaining long positions from down here. I'm back to flat. Bulls want high 261, high 250, and bears hope to break below the low of the day. I was careful with my wording when I called this a major bull surprise. I said that when you have a really exceptionally strong surprise move, it usually dominates the remainder of the day, not just the next few bars. And I said that it makes it unlikely the day would end up having a big bear trend. But it could be a trading range day and have big bear legs, which is what it has been doing. Bears buying back their shorts in a panic. They're deciding that there are not enough people willing to sell down here, so bears are buying back shorts. Some bulls buying the momentum up. If you're quick, you buy once you see the momentum up. Surprisingly strong move up. And you can see it was mostly bears buying back shorts and not bulls getting along. Why do I say that? Because it immediately went down. There was no one willing to buy high. So bears panicking out of shorts as it's going up. Quick bulls bought and scalped, but nobody willing to buy at the top. And we have to go down to find buyers. If a bear were still short, I would get out 5 points above any bar, including 69. Can this still become a reversal up? It's possible. It doesn't really matter what a bar does while it's forming. When you look at a chart at the end of the day, you only see what the bar looks like once it closes. A 25-point tall bar, more than 25 points tall, and a reversal. Can the bulls do anything bullish with the bar? Can they get it to close above 69? Can they get it to close above the double bottom? Can they get it to close above the midpoint of the bar? And they fail. However, it scares the bears when they see a 25-point rally over the course of just a couple minutes. It makes them hesitant to sell too low. Best choice right here, flat. If I were short, I would get out 5 points above 69. And is it strong enough to sell again on a stop below 70? You're selling at the bottom of a trading range day, and your risk theoretically would be above 70, and that's too much. So I would not sell below 70. We might get an IOI 71, an inside bar after an outside bar. And if it's a bear bar closing near its low, you will get bears selling. If it's a bull bar closing near its high, you'll probably get bulls willing to buy. Lots of reversals. And that makes it mostly a scalper's market. We had a good swing above 21, 22, 50. And the sells below 54, 38, not very good, even though it turned out they were both profitable. Even below 63, same thing, 63, 64. Part of the reason why 70 topped out where it did is you had limit order bulls 63 low, thinking it was a bad sell. They bought the 63 low and they bought more lower, 5, 10, 15, 20 points lower. And then once it got back to 63, they sold. So part of that big tail on the top of 70 is bulls selling out where they originally bought. So they get out, break even on their first buying with a profit on their lower buys. And the bears know the bulls will do that. So the bears also sell around that 63 low. IOI, breakout mode. For the bears, it's a low 1. If they sell it, I'd get out above 71. But I think most traders do not want to sell too low, and this is pretty low in a trading range day. The bulls are hoping it's the opposite of 54. We had an IOI after a rally, and we had a bull bar 54. Now we have an IOI after a sell-off and a bear bar 71. Not going to attract a lot of sellers, not going to attract a lot of buyers above 71. And for the bears, it's a swing sell. But I think it's, for me, I'm not going to take it. We've had a lot of reversals today, so I do not want to sell too low. With it always in short, why would anyone hesitate to sell below 71? In part because of 70. Traders see that the market can rally 20 points or 25 points in a matter of a couple minutes. So their risk is greater than what they want. New low of the day. Can we collapse? Probably not. How far down can we go? I'm not sure, but I doubt we're going to collapse because of all the trading range trading that we've had. We're down almost 4% on the day, which is a very big move down. You look at the daily chart, you say, oh, that's not that big a bar. Right, but we're down from Friday's close. So the move down from Friday's close is right now 3.8%. So it's a very big move. We got that double top on the daily chart. And here's the neckline. And this looks like it could be a breakout test. We broke below a year-long trading range. Sideways for about a year. And this could be simply a pullback, testing the breakout point. We went a little bit above it. But this whole thing could lead to a big measured move down. So top of the year-long trading range, the bottom, a pullback above the bottom, and resumption down. So measured move down from there to here, resumption down. So measured move down from there to here. I don't have it in, but let me put it in. I think I have it on the weekly chart. I'll just leave it on the weekly chart. Here it is on the weekly chart. First, I'm using the double top for the measured move, but the market might be using this high and viewing this whole thing as a trading range. A breakout below, a pullback above the breakout point, and a resumption down. First target is the measured move from the double top. But if we go below that, the next measured move is from there, and then the next one is from the top of the year-long trading range. This is sell for any reason. I would get out with a stop 5 points above a bear bar. I'm currently flat. I might sell some closes and add on. If I do, I'll trade very small and add on if it goes lower. Is this going to be like that trading range breakout that we had last week? Over here. Trading range for half the day. And we broke out. And this was, I think, very important. I mentioned it at the time. consecutive big bear bars closing near the lows, it increases the chances that it's going to be a measuring gap. So can the bears do that again today? I still think no. I think the rally was big enough to make a big bear trend unlikely. This is what the bears are hoping will do, accelerate down late in the day. The more we get bear bars closing on their lows, the more bears will sell at the market and below the low of bars. And for the bulls, another parabolic wedge, 66.70, but they'll need a decent buy signal bar. Bears, I'd get out above a bull bar, any bull bar, even a small bull bar. I'd get out maybe a few points above a bar closing in its middle. You can always sell again if 74 or 75 is a bear bar. And for the bulls, a big high 250, parabolic wedge, 3 legs down, 66.70, but 3 bear bars. So I think it's good enough to exit shorts 2 or 3 points above 73, but I don't think it's worth buying above 73. Another breakout and hesitation. We broke 67, we broke below the double bottom and hesitated. And now we're having another breakout and we're hesitating. The bears who sold the close 72 are disappointed by the tail 73, and they're unhappy that the market came back to their entry price below 72. Can the bulls get a bull bar closing near its high? It would be better if 74 remains an inside bar. You'll get more bulls buying above. With the trading range trading that we have, it's probably going to go above the 73 high. It just did. Because trading range days, nothing is going to be the way a stop order trader wants it to be. It's a limit order type of market. It's a scalping type of market. So you'd have to expect things that swing traders want, things that stop order traders want, they're not going to get, or they'll get very little of it. If it's not a good buy, can you sell the 73 high? It's late in the day, and we're at the low of the day, and we've had a lot of reversals. If this were earlier in the day, I might be willing to take that chance, selling the 73 high, but not this late in the day. We've got a parabolic wedge, different ways to look at it, 1, 2, and 3, a big high 2, a lot of reversals. I really don't want to be selling too low unless we get a very good looking sell setup. 74, a multiple of 2, and therefore it corresponds to the close of a 10-minute bar. On the 10-minute chart, the bulls are hoping to get a good buy signal bar. They want the bar to close near its high. I usually only trade one chart at a time, and most of the time, 99% of the time, I'm trading a 5-minute E-mini day session chart. And when I'm not in the chat room, especially if the market is doing a lot of sideways trading, I'll sometimes trade off the 2-minute chart. You can also trade off a volume chart or tick chart, like 5,000 ticks to a bar. That's actually very similar to a 2-minute chart. One thing I don't like about the tick charts is that the amount of time needed to complete the bar changes throughout the day. During quiet times, a bar can take 5 or 10 minutes to close. And when the market's moving quickly, a 5,000 tick bar can close in just a few seconds. And I prefer predictability, rhythm. So I like time charts better. Bears, if they get out above 70, 73, we're still always in short. Theoretically, if you're trading always in, you sell either below a bear bar closing near its low or below the most recent low, so below 73. But I think the math is really not good unless you're willing to swing trade. It did not go 5 points above 73, so bears exiting 5 points above the high of the prior bar theoretically are still short. Another low one, and it's an okay swing. You know, we could easily keep selling off for the remainder of the day, but I'm not willing. With all the reversals that we've had today, I really don't want to sell at the low. And you buy above 76 if it's a bull bar. Probably not. 5 consecutive bear bars. The past 10 bars, 12 bars, we've had only 2 small bull bars. So I think it makes it unlikely that we're going to get a reasonable buy signal before the end of the day. Bears, reasonable to get out of shorts, a few points, 5 points above any bar, 75. But bulls, we're just not getting what most bulls want. So most bulls are going to feel like we've run out of time and they're not going to buy again. Similar to 70, break on above the bar and a pullback below the high of the bar. Similar to 74. Low one, always in short, but a bull bar at the bottom of a trading range. We're not getting a breakout with consecutive big bear bars. We have consecutive big bear bars 71, 72, but they're not both closing below 70. Theoretically, stop entry short below 75. Anytime there's a reasonable location to exit a short, the bears, if you're trading always in, will sell again below a bear bar closing near its low, not 76, or below the most recent low, 75. And it looks like a lot of them scalped for 5 points here. It fell a little bit more than 5 points and then bounced. So a lot of bears are buying back shorts with 5 points. Some of it bulls buying. Computers might do it, especially if they can hold into the evening session or overnight. But individual traders, when the market's in a strong bear trend, it's usually worth buying only if things are perfect. And a limit order buy below 76 is not perfect. Any buy above 77, mini wedge 73, 75. The problem, there's always a problem, right? But you're at right at the end of the day, and you're risking 15 points. And how much profit do you stand to make? You know, are you trying to get 30 points profit? Unlikely that you'll get that. You'll probably have a hard time getting 15 points profit. And therefore, your risk is greater than your reward. And the probability is not particularly good because we've had a pretty strong sell-off over the past hour. So really, it's one of those things that's better to watch and do nothing than to buy and hope that we rally strongly from here. And if it does rally strongly from here, it doesn't matter, right? The probability, if you do this trade 10 times, 2 or 3 of the times, you're going to get a huge rally. But most of the time, you might rally a few points, maybe 5 points, and some of the time, a few times, you'll get stopped out and you'll lose 15 points. So one time getting stopped out, 15 points, erases 3 5-point wins. So that is not good math. The bulls have bought above 77. they're wondering what to do. A lot of them will get out around break even. It could still rally 15 points before the end of the day, but I thought the math was bad to take the trade, and I would not take it. I sometimes will take one of these late reversal trades, but I really need things to be perfect. And that's a small bull body. It's a big bar, big risk, and a tight channel. So, and not too far below the average price. And this is not a perfect buy. It's not like 21. On the 5-minute chart, it's not all that bearish. We had a very strong rally in the middle of the day. But on the daily chart, it's very bearish. Daily chart, we're breaking strongly below an important price and attempt at a bottom. And we're collapsing. When you get these free fall type of collapses, how many bars can you get like that? Can you get 5, 10? Probably not. Normally, after you get 3 or 4, you'll get a pretty big bounce, even if you're going to end up with a very big sell-off. Now, just look back at the pandemic crash. So we had a big gap down in 4, and then we bounced. And that was the last time that we had a series of 3 or 4 big bear bars. We sold off a lot more, but once you've had 3 or 4 big bear bars, normally you're going to get a bounce. You know, as I said, we may bounce into the FOMC report on Wednesday. And you can just scroll back and look at any big collapse. You know, normally, if you get a few big bars, you're going to get a bounce, a pretty good bounce. Here, 2 big bear bars, a bounce. 2 more big bear bars, a bounce. A lot of interesting things going on. Big gap down increases the chances of a trading range open. And we were sideways for 5 hours in a big triangle. And then we sold off at the end of the day. And early on, we were sideways for about 8 bars. We have a big bull bar, but a tail. So that will reduce the number of bulls buying above 1. And then 2, we have a big bear bar closing on its low. However, we're far below the average price, the moving average, and it follows a big bull bar, so nobody wants, it's just not bearish enough. If you're going to be selling far below the average price, you don't want 50% of the trading being up bar 1. And bar 3, a second reversal up from below the May 20th low and below yesterday's low, but only a doji bar after a big bear bar. So probably sellers above, low probability buy. And then 4, we have a micro double top, 2, 4. It's another sell. It's still on the sell below 2. Now it's a sell below 4. And the market did not stay. It did not stay. I think it went above 4 later in the day. But now the bears got a swing down. It's still not a very high probability sell, far below the average price. And the bull's a high 2-6, but a bear doji, consecutive dojis, limit order market, not good. Inside bar 8, low 1, but not very good. And then 9, we're breaking out. And you'll start to get bears selling the market, selling the close. A lot of bears will wait to see if we get consecutive bear bars and then sell. But a breakout is more likely to lead to a trend down, bear breakout, if the bar is big and closes on or near its low, like bar 9. And it'll become more likely to lead to a trend down if you get a second consecutive big bear bar closing near its low, bar 10. So now it's sell the close, always in short, and we should get at least a second leg down. And when you get a very strong breakout like this, you usually get a third leg down. So instead of looking for a reversal with a high 2, we may end up getting a wedge. Bulls trying to reverse 12, trying to reverse 13. Okay for bears to get out above 12 or 13, but I think it's not good enough to buy. I think we'll get more of a second leg down, maybe a third leg down. And if the bears do get out above 13, 14, and it's still always in short, so they should sell again below a bear bar or below the prior low, the 13 low. 14, a low one short. We should get more down after 9 and 10. You could sell it and put a stop above 14 or use a slightly wider stop. Bears and micro double top. Might be sideways here, but I would not be long, and I would either get short or stay flat. Bear surprise 15, so we should get at least another leg down, which means we'll probably have at least 3 legs down. This is interesting. 17, we have a bull bar closing near its high, and we have a high 2 with 12. And we have a parabolic wedge with 3 and 13 and 17. But 9, 10 is strong enough so that we may get 3 legs down from 10. So 10 might be the first leg, and then 16. So if you're buying above 17, first of all, I definitely would get out of shorts above 17. If you buy above 17, you have 2 ways of handling it. One is you buy above 17 and put a stop below 17. The other is you buy above 17 and you do not exit below 17. You use a wide stop and look to scale in below, either buying the 17 low or buying 10 points below the 17 high, assuming the buy signal triggers, or you wait for a third reversal up, which is what we got. Bears a low one, 18. Some bulls will get out below 18 and then look to buy again on another reversal up. And for the bears, it's a low one and a bear trend, but I think we'll probably try to get a wedge bottom. So 3 legs down, 11, 16, and then 19 or 20. So if you're selling below 18, you have to be quick to make decisions, because I think we're going to get a reversal up from below 17 if we go below 17. Another bear surprise, but smaller. Big bear breakout, 9, 10. Medium breakout, 15, 16. Probably a smaller breakout here. So I'm either long, which I was, or I'm looking to buy, which I also was. And then we got 21. Outside up bar, big bar closing on its high, closing high above 20. A high 2, 17, a parabolic wedge with, you can say 13, 17. It's a good candidate for the low of the day. Certainly a good candidate for a swing up for an hour or two. So I think buying above 21 is a good trade. A really good entry bar 22. Pretty much a major bull surprise. It probably will control the remainder of the day. And that means we probably will not end up with a big bear trend. We may go below 21, but we're probably not going to go far below 21. The best the bears probably can get is a big trading range or a test of the 20, 21 low. 23, a very strong bull surprise, major bull surprise. It makes a strong bear trend unlikely. This will probably influence the remainder of the day. We should get at least a second leg up. It's by the market, by the close, stop below 21, but you can also get out 5 points below any bar. And for the bears, a 20 gap bar sell signal, a double top 14, a bear bar closing near its low. But such a dramatic reversal up, a lot of traders who did not buy are eager to buy, and they'll buy the first reversal down. And a lot of the bears who did not exit shorts will be relieved to lose less, and they will buy back the shorts below 24. We might get down and test the 21 high, the 20 high. It's a bad buy signal bar. But the reversal up is so strong, I think the first leg down will not get that far. Bulls will buy the 24 low. They'll buy a 50% pullback. They'll buy a test of the 18 high. High 1, 25, but only a doji. However, we should get at least a small second leg up. So if you buy, you're holding for a swing. 27, a low 2, 24, a wedge with 14, 24, a wedge with 18, 24, but a bull bar. probably a minor reversal. So I would not sell below 27 or 28. We might come down and test the 25 low, but if we do, we'll probably get a double bottom. For the bulls, 28 is a high one in a small pullback bull trend, and we might get to the 9 high, the start of the sell climax, and we get above the open of the day, but it's a third leg up, and we have bad follow through 24, 25, 27, 28, so it increases the chances that we'll get a wedge rally, and therefore buying above 28, probably better not to do it. Did not trigger. Instead, we got consecutive bear bars. Does it sell the close? We're still a 20 gap bar sell. I would not. I think the rally was so strong, we're probably going to be sideways to up for a couple of hours. And so I think it's not very high probability betting that we're going to go down much. I would still be looking to buy for any reason. 30, a high or low double bottom. 25, a high one, but the two big bear bars. So we might be in a limit order market. You can buy it, put a stop below 25 or a few ticks below 25. And for the bears, a small head and shoulders top, 24, 27, but I still think we're going higher. And we may get 2 or 3 little legs down to the 25 low and then go higher, but this is not what I want to sell. Tight trading range here, and then outside up 36, but a tail. Bulls want the breakout to succeed. Might get a measured move up from the 25 low to the 33 high. That would get us up to the high of the day. And the bears are hoping that we fail. Maybe a wedge 27 and 33. A couple decent bull bodies. You can argue wedge 27, 33, but I'm not going to short below 38. The bears are hoping it's just a bull trap in a trading range day. I would get out of longs 5 points below a bull bar, 1 tick below a bear bar closing near its low. Bears, a big bear bar closing near its low. It might be like 24, 27, 28. There might be buyers here. I think it's reasonable to get out of longs just in case this is a failed test of the May 20th low and the open of the day and the high of the day. But to short, I would like to see at least a second bear bar or a third bear bar. Bears have a second bear bar. If you short below 47, stop is above 38, so you're risking a lot, and therefore you'd have to trade very small. And then 41, a bigger body, accelerating down, close below the moving average. It's probably sell to close, but I think it's a minor reversal. So I think we'll try to get a double bottom 29 or double bottom 25. So probably not a lot of downside. More bear bars, so accelerating down. It's sell to close, but you have to be very quick to make decisions because the odds are we're going to try to get a double bottom 29 or 25. That means the odds are we're going to reverse soon. 5 good bear bars closing near their lows. Bulls will want a second reversal up, so they will not buy the first bull bar. 44, a bull bar closing near its high. Okay to get out of shorts above 44 or 5 points above 44, but I would not get long. I would wait for a second buy. And for the bears, a low one, 46, but 2 bear dojis right above what I think will be support, 25 low. So if you sell it, you're hoping we collapse, knowing we probably will not. So you have to be quick to get out. Weak breakout below the low one, 47, 48. Bears trying to accelerate down 49, but it might be just a sell back in test of the 25 higher or low. So I really don't want to sell here. I'd rather look for a reversal up to buy. And we have a pair of consecutive outside bars, outside down 49, outside up 50, closing on or near its high. A second reversal up 44, higher low double bottom 25. I think it's a reasonable buy for a swing. You want it to accelerate up. The sell-off is so strong, it's possible that we just go up about halfway, 50%, and form another lower high, and then have a triangle, 2 lower highs and a higher low. Very good bull bar 51. We might get back to the 38 low and the 38 close. So right now, it's probably always in long by the close by the market. And 52, same thing, except here, we're at resistance, the open of the day, and near the 38 low. So if you do buy here, you got to be quick to get out. Outside down 53, but a big enough bull surprise. The first reversal down probably will be minor. Bulls, you can get out below 53, but I'm not willing to short yet. And disappointed bulls have bought 52, 52 closed, disappointed 53. We had that tail 54 that tells us that a lot of the bulls who bought 52 or above 52 placed a limit order to get out. They were willing to lose 2 or 3 points. Looks like they placed a limit order about halfway up from the 53 low, and that's not good for the bulls. For the bears, it's an IOI, and we now have a third high, so it's a triangle, but it's probably a minor reversal after those 3 pretty good bull bars. So I'm not willing to sell below 54, but I would get out of longs below 53, a bear bar closing near a low in the neckline of a micro double top. And then 55, 56, consecutive bear bars closing near the lows, closing below the moving average. But we're still in a triangle. And half the time when you're in a triangle, the first breakout up or down will fail. So yeah, you could sell 56 and hope that we break below 50. But 50-50 chance we're going to reverse instead of break out. Another sell the close bar, but this could be a double bottom pullback, double bottom 25-50. I don't like to sell right below a double bottom, right above a double bottom, so I would not take that sell. I would wait for it to break below 25 and then sell lower. And then we got a reversal up 58, 2 legs down 53, 57, but 3 pretty good bear bars. I'm not going to buy the first reversal up. And for the bears, a low 159 at the moving average, but right above a support zone where the bulls bought many, many times today, over here, over all through this area. So I'd rather sell a low 2, maybe a double top bear flag, 59.61, or sell after a strong breakout below the low. So I'm not willing to take the sell. And the bulls, we have a perfect double bottom, 25, a high 2, 58. You can call it a wedge, 53, 57, but a bear bar, and just below the moving average. So that's not a very good buy. I'm going to wait to see if we break strongly above the moving average. Also, we're at the apex of a triangle, and you can say we're breaking below the bottom of the triangle. 50% chance the breakout will fail, but that's not a good enough buy for me. 62, a bull bar, but big tail, barely closing above the moving average. So it's not by the close. For the bears, a double top, 59.62, but a bull bar and a tight trading range, 57. So I'm not going to sell below. Bears, a bear bar closing in its middle, 64, a double top bear flag, 59. To me, it's just not a good enough sell. It's probably a pullback from 62. Can you sell it? I would wait for more bear bars. Okay, 66. Now we got 3 bear bars. The bodies are increasing, so the momentum down is increasing. You can sell the 66 close. I would wait and sell either on the stop below 61 or wait to see what a breakout below 61 looks like. We're at the bottom of a trading range 24, and most breakout attempts fail. So this is not a high probability sell. For the bulls, a failed breakout below the double bottom, but 3 bear bars, 2 of them reasonably big. 67, a big tail. I don't want to buy above 67. So it looks like it's a pullback from the breakout below the double bottom and not a reversal from a failed breakout below the double bottom. So I want to sell maybe 68 or 69. Outside down 68. You can either, I would sell below 68 and take a chance, or wait to see if we get a big bar closing far below 68 and the double bottom. A second bear bar, but tail, We have the Doji 67 and the breakout 69, but a tail. This is not strongly bearish. If you sell the close, I would exit maybe 5 points above 69, maybe 3 points above. And for the bulls, I'm not willing to buy a failed breakout below the double bottom, but a 7-bar bear micro channel, and with too many big bear bodies. And then we had that very big outside up bar 70, but it closed back below the 69 high. So that's not what the bulls want. It looks like it's simply a breakout test of the 63 low. 63, not a good sell. And just like 54, not a good sell. The market came back to test the low of the bar. What do you do here, 70? I think it's good to be out of shorts, but there's not a reason to get long. We have an IOI 71. We're in a tight bear channel. The bears are trying to get to a new low of the day. You can sell it for a swing and hope that we collapse, knowing we probably will have a hard time going much below 21 after that big reversal up, 21, 22, 23. Bear bar closing there is low, 72, 73. We're breaking out to a new low of the day, but a big tail. I'd get on shorts, 3, 4, or 5 points above any bar, 73, but it's not a good enough buy. Parabolic wedge, 66, 69, 73, but not a good enough buy. And then a big tail on the top of 74, a low one. Again, a possible parabolic wedge, now 70, 73. If you sell below 74, you got to make quick decisions. I'm not selling here at the moment. If we start to get bigger bear bars closing near the lows, I'll sell again. And for the bulls, a parabolic wedge, but 5 bear bars, I'm not buying. Bull bar 76, but tail, I'm not buying. And then 77, it's a micro double bottom, 75, a parabolic wedge, 73, 75, a bull bar, but the body's not big. We're not far below the moving average. And the risk is big. The bar is 15 points tall. So I'm going to not take the buy. And then we drifted up at the end of the day. Stop entry traders today. The first stop that I would consider would be below 4, and then below 9, 10, maybe 11, and then below 14 or 13, and then below 15, 16, and then 18. I thought a parabolic wedge was more likely, so I would not sell below 18. I would buy, first stop entry buy, I would buy about 17. I would buy definitely about 21, 22. 23, we're right at the moving average. If you buy, you might have to sit through a 50% pullback. A high 125, not great, but okay. Same with 30. 36, not great. 37, not great. For the bears, I would wait for 2 or 3 bars before selling. 40, 41, 42. I would buy above 50, maybe above 51, maybe above 52, probably not above 52 because it's right at open of the day, which is an important resistance level. We failed there, 39, and we might be forming a triangle. And for the bears, some would sell below 53, the neckline of the micro oval top, the IOI. Others would wait to sell below 55 or 56. I'd get out of shorts above 58. I would not buy above 61. I would not sell below 63, 64. 66 you could sell on a stop below the double bottom, but it's really not good stop order selling. Then some bears will sell below 70 or 71, but we're getting a lot of reversals, and I think it's better not to do anything. Limit order traders, early on, I think most traders should not do anything with that. Bears, they could sell the 12 high, but they need a wide stop. And down here, I would not sell 17. I would, limit order bulls, they probably would buy the 17 low. They'd probably buy the 24 low. But you have to ask yourself, why does 24 look like that? If this is the start of a strong bull trend, you're typically not going to get a big bear bar closing near its low right at the moving average. So yeah, we're probably going to get a second leg up and probably buyers below, but something's wrong. And same with 27, probably buyers below, but it's just not as strong as the bulls want. And then limit orders here, probably sellers above 44, but be pretty low in a developing trading range. Probably buyers below 52, probably sellers above 57. And then here, probably sellers above 69, and probably sellers above 73. What about selling above 75? Now it's a possible wedge, third leg down, so it's less good. Let me take questions. I have a few comments after the questions. Question, you mentioned during buying the 17 high and scaling in lower. I exited below 18 when I saw a gap open with 13 low and the 18 high. Scaling in lower works once we see limit order bears make money. Can you please comment? Yeah, I talked about that. I said you could buy above 17. Most traders should either get out below 18 or below 17, and then look to buy again if we get a third reversal up for a wedge 21. But if you trade small enough and are not afraid of what the market might do, you could buy above 17 and not put a stop down below 17 and just use a wide stop like 20 points down and look to add on more as it goes down. And then once we get that third reversal up 21, that's a good looking bottom. We should rally for a couple hours. So I would put the stop below 21. And if it gets below 21, then reevaluate. But that was a pretty good parabolic wedge buy in a day that has had a lot of trading range trading up to that point. So we should go up for a couple of hours. Question, is the bull signal bar 21 outside up or 20? I guess he's asking, do you buy above 20 or do you buy above 21? I think most traders will make more money if they patiently wait than buy above bull bars, especially bull bars closing near their highs. So it's a parabolic wedge 20, but it's a bear bar. I think it's better to buy above 21. You can say, well, I don't want to risk that much, but look at the profit potential. You know, the bulls have bought there. They could have made 40 or 50 points. So you just buy above 21, put a stop below 21, and go to Walmart and come back in an hour or two and see what you get. And, get out somewhere in here, and, you'll have made, 30 or 40 points. That's what traders should be looking for. To make a living as a trader, it's fun to take trades throughout the day, but this is where you're going to make a living as a trader. Just do nothing and wait for 21 or 17 and then buy and manage your trade. That is how to make money as a trader. And, I think for most traders, that is the single best thing they can do. Every day, in the first hour or two, look for a swing. If there are swings later in the day, 50 I thought was a pretty good opportunity for a swing. And you just, you'd make a whole bunch of points above 21, and then you try to make 10 points or 5 points 2 or 3 more times during the day, just patiently waiting. So I think for most traders, it's better just to patiently wait and, let things go, let things go, let things go. And then when you get something that looks especially good, take that. I said I wanted to say a couple things here at the end of the day. And I want to put up the monthly chart. Very strong bull trend. But sometimes you'll have a very strong rally, and instead of a bull flag, you get a trading range, a very deep reversal down. So, for example, below that high, the pre-pandemic high. At this point, I think we're not going to get below the pre-pandemic high. The other day I said 30% chance, maybe 40% chance after today. But I've talked about stocks on and off over the past many months. And Apple, this is a monthly chart of Apple. I said it looks to me like a spike pullback channel, parabolic channel. It looks like we're coming down here. Maybe 100, maybe 110, and we're at 130 now. So it looks like we may fall another 20% in Apple. And once we get here, what happens after a spike pullback channel? Well, you get a bounce. And then what happens? Usually you enter a trading range. So Apple might be in a trading range for the next couple of years, the next several years. This took 2 years from here to there. So we could easily go sideways for several years. Amazon, they did a 20-to-1 stock split. And look where we are, just above the 100 big round number. Strong breakout, then sideways, you can call it a higher high, major trend reversal. And we're reversing. You can call this a triangle or a trading range or a possible final flag. And it looks like Amazon is going to come back to this area. So whatever that is, 85 or something. It's also the bottom of the most recent leg up. So it looks like Amazon is going lower. It looks like Apple is going lower. Alphabet, Google. The pre-pandemic high is so far down, I don't think we'll get there. But we could retrace 50% of that. Meta, the new name for Facebook, we're just above the pre-pandemic low, so I assume we'll get down there. NVIDIA has become the biggest semiconductor stock. Well, Taiwan Semiconductor is the biggest, but of the ones people talk about regularly, it's the most important one. And same thing, a rally, a parabolic rally up from a trading range. So a potential magnet, final flag. So it looks like we're going down here. And since that's near 100, we may get down to 100. JP Morgan, this is the pre-pandemic high. We've already retraced it. And we have an area of agreement here and here. So I suspect we're going to come down here, which is right around the 100 big round number. So on all of these really important stocks, there's one phrase I keep saying, that we should come down to, something, X, Y, and Z. But I keep saying we should come down. And if all of these major stocks are going down, the S&P will have to go down as well. And this is the S&P, the E-mini. Oh, I want to say one other thing while I think of it. Here's a monthly chart of the cash index. And I'm going to say something that sounds stupid, but it's not. It's actually smart. If I just draw a trend line across these lows, you look at that and say, I'm not going to get to that trend line. It's too far down. Well, we're going to get to this trend line. Are we going to go down to it over the next year or so? Probably not. But we're going to reach this trend line. It might take several years of sideways trading, but we're going to reach this trend line. How do I know? Because it always does that. And now I got to do it this way. Here's the bottom of the financial crisis. Okay. Now, believe it or not, I was in a chat room back then, and with some pretty good traders. And at the time, I don't know if I can draw it. Anyway, maybe it was on E-mini, but there was some trend line that you could draw, maybe that low. This is the 87 crash, and this, and if you drew it, this collapse went right below that trend line. And at the time, I told the guys in the trading room on the 5-minute chart, there was a reversal up on the 5-minute chart. I said, hey guys, not only is this a reversal on the 5-minute chart, this might be the lowest price you'll ever see in the S&P again in your lives. And now you can imagine the criticism I got, for making a ridiculous claim like that. But it turned out to be true. That there was a 5-minute bar that took place here. And the reason I said it was because we're at a monthly bull trend line, and it's based upon a really important price, the 87 crash. Now, something about the 87 crash. Again, I might not be able to draw it. Probably can't do it the way I want to do it. But anyway, the 87 crash. What do you notice? It came right down to a monthly trend line and reversed up. The market rarely hits major monthly trend lines, but it always eventually hits a major monthly trend line. So anytime you see a monthly trend line, you know the market's going to get there. It might not get there for 10 years, but it's going to get there. And the market is going to get to this trend line. Again, I doubt it's going to get there on the first time down, but this might be the start of this, and we could be going sideways for 10 years. I've been saying that for the past several years, that I thought at some point in the next several years, now, maybe a couple of years from now, we would enter a trading range that would last a decade. And I still believe that's true. And is this the top of the range? I don't know. I think we'll probably go above it. But I do think we're not going to go much above it. And I think this is the next 10 years, sideways. Look at the late 60s. Here, sideways for a decade. I think this is what the future will be in the stock market. A decade of sideways trading. And that's fine. But if the market is sideways, it's a trading range. You have to trade it. If you're going to make money, you have to trade it. You have to be buying low and looking for pretty good bounces and then exiting and then look for the next buying opportunity. And what about what I regularly say about if you're young, it's better just to buy and hold and buy more and hold and buy more and hold. That's still true. So if you're a 30-year-old guy, and you have a 401k or IRA, it's still probably better to continue to buy, even though the market might be sideways for a decade, because it might not be. It may do this and then just keep going up and up and up without doing that. So for retirement accounts, I think you just buy and just keep adding, especially if you have 20 years left before retirement. That's probably the single best thing to do. But if on your trading account, I think we're probably going to have a lot of trading activity. I talked about value stocks the other day, and ARK is kind of a good surrogate for value stocks. ARK is an ETF, and it was created by Cathie Wood, and this is a monthly chart of ARK. We've already retraced that huge rally from last year. She became famous last year, having the most profitable fund on Wall Street. Everyone thought she was a genius, and now she's the exact opposite. But anyway, this is a basket of a lot of high-tech stocks: Tesla, Coin, a Bitcoin stock, Shopify, and Snapchat, Roku, Netflix, a whole bunch of stocks that have a lot of volatility. And one way to trade it is just trade instead of looking to buy a bunch of individual stocks and holding them for a day or two or three for a month. You can just buy Cathie Wood's ETF and then just look to trade it. I talked a few times about the volume of her ETF. Here's the 5-minute chart. Okay. So we got a little bar right here. Okay, what's the volume? Okay, 200,000 shares. All right. So on the 5-minute chart, the volume is tremendous, and you can just enter at the market. You don't even need stops. You're going to get good fills. Some of these bars are probably 1 million contracts. Here, 800,000 contracts. Here, 1 million contracts or shares. This is an ETF. So, but anyway, stocks. Back over here, I bought her ETF and for a swing up, and now I'm looking to buy again. And you could do the same thing with any of her stocks. Shopify is a pretty good company. And so you buy a little bounce, hope it breaks to the upside. When it tries repeatedly and fails, you get out. Square, another good company, same thing. You notice they all look the same. All these charts look the same, but there are a whole bunch of them like that. Snapchat, Roku, Netflix, they're all, it's all basically the same. And to get rid of the market risk of an individual stock, you can just go ahead and buy a basket of them. And one way to buy a basket is here, Kathy Woods' ETF. And a lot of people trade it. How do I know? Well, look at the volume today. 37 million shares were traded. So it's just incredibly popular trading stock. E-mini might go down a little bit more. We'll probably get a pretty sharp bounce, 150, 200 points sometime this week. What about the FOMC meeting on Wednesday? As you know, I think Chairman Powell is a fool, and I suspect I must be a fool because I'm the only person who says that. Everybody else talks about him as being a really good Fed chair, but I think he's a fool. And the most recent stupid thing he said was a 75 basis point interest rate hike was off the table, and that's just totally stupid, right? He should have raised by 3/4 of a point the last time, and he should be raising 3/4 of a point this time as well. He's been too slow to make up his mind that to realize that everybody expects higher interest rates. So just go ahead and give us the higher interest rates and slow down the economy and let the economy recover. Instead, he's letting it slowly bleed to death. I don't understand it, and I really don't understand why the experts I see on television or the experts I read on the internet, people I respect, I really don't understand why Powell is not being strongly criticized. He's clearly mismanaging things, but that's the way it is. What he's doing, nobody's complaining about except me. All right. Hope everybody has a good night.